Chapter 13 goes over corporations only. In the past, we went over sole proprietorships, partnerships. We touched on a tiny bit, but this will basically just be all on corporations. So let's go ahead and go to slide number 25. So basically, when we talk about corporate capital, we either have paid-in capital or retained earnings. Paid-in capital here, the total amount of cash and/or other assets paid to the corporation by stockholders in exchange for capital stock. Remember, it doesn't have to be cash. We can contribute property or what have you. Retained earnings is net income that a corporation retains for future use. So basically, they have to have net income in order to have retained earnings. Let's go to slide 29. Viking Corporation issued 300 shares of $10 par value common stock for $4,100. So when we have this journal entry, we're going to debit cash because we sold shares of stock to get money. So that's going to be $4,100. The common stock here is always going to be the par value. So right over here, we have $10 par value. So we're going to take 300 shares times the $10 to come up with the actual common stock. And any difference will be paid in capital in excess of par. So when we do these journal entries, this is going to be a plug-in number to the cash, the difference between the cash and the common stock. Again, common stock par value is that's going to be your key indicator of what to get over here. So let's go over to the next slide. Norfolk Corporation issued 600 shares of no par common stock at 10.2. Prepare the journal entry if the stock has no stated value and the stock has a stated value of $2. So no stated value stock, as you read in your book, it's just going to be a simple entry, debit cash, credit common stock. For the second one, for B, since we have stated value of $2 per share, remember the stated value is going to go in the commons, is going to be credited to the common stock. So we're going to have 2 times 600 shares is going to be $1,200. And basically we're going to get 10.2 because it basically states that in the problem. And again, that difference between the cash and the common stock is is paid in capital in excess of stated value. So again, this number is going to be a plug number. We can also issue common stock for services in regard to attorneys, consultants, non-cash assets. We can give stock for land or equipment. The cost is either the fair market value of the consideration given up or the fair market value of the consideration received, whichever is more clearly determinable. And we're going to see in this next example that what makes it determinable is the market value of the shares on the exchange. So let's go ahead and look at that. On March 2nd, Leone Corporation issued 5,000 shares of $5 par value common stock to attorneys in payment for their bill. So basically, here's some stock, and we want to basically pay in exchange of giving you cash. We're going to give you stock for services provided in helping the company to incorporate. So organizational expense is going to be debited for $3,000. Again, expense that's going to go on the income statement, and common stock is credited 5,000 times 5. As we can see up here, issued 5,000 shares at $5 par value. So that's going to be 5,000 times 5 equals 25,000. And again, that difference is going to be paid in capital in excess of par, and that's always going to be a plug-in number. Plug-in meaning you need to get these two first before you get that. One more example, Kane Incorporated, Kane Inc.'s $10 par value common stock is actively traded in the market for $15 per share. Kane issues 5,000 shares to purchase land advertised for sale for $85,000. So in order to the journal entry to acquire the land is we're going to debit land for $75,000. The way we're going to get that is 5,000 times $15 per share. The market value, this is more readily available because it's already on a public exchange at a price, but at a price that we all can see. So that's going to be debited for $75,000. The common stock is going to be 5,000 times 10 because that's the par value, and the difference will be additional paid in capital or paid in capital in excess of par.